Welcome to Talk Tickers, where we break down the earnings calls that are moving the market. Today, we are diving deep into Aware, the biometrics company. Their latest quarter was a real head-scratcher. The numbers looked weak, but the stock popped. So what's really going on here? Let's get into it.
All right, here's how we're going to break it all down. First, we'll look at that strange disconnect between the results and the market's reaction. Then, we'll unpack the story management is telling investors. After that, we'll check the pulse of the market and see what it's demanding. We'll also look at the big growth drivers down the road. And finally, we'll give you our take on the next call, complete with a rating and a trade idea.
Okay, so let's start with the central puzzle. On the surface, Aware's Q2 report seems like bad news. But the market saw something completely different.
And here it is, laid out plain and simple. On the left, you've got the financials. Revenue down more than 9%, a loss of 8 cents a share, a net loss of almost $2 million. Yikes. But then look to the right. The stock jumps over 8% after hours. So the big question is, what on earth were investors so excited about?
To figure that out, you have to ignore the spreadsheet for a minute and listen to the story. Because this quarter, for Aware, was all about changing the narrative. It wasn't about the numbers today, but about the promise of tomorrow. And this quote from the CFO, David Travers, is Exhibit A. He basically told the market, hey, don't worry about these numbers. It's going to be messy for a bit because we're in the middle of a huge transformation. It's a classic move. Frame the weakness as a planned part of a bigger, better strategy. So, what was the specific excuse for the revenue dip? Management pointed the finger at these things called perpetual license sales. Think of them as big, chunky, one-off deals. They don't happen every quarter, so they make your revenue look really lumpy and unpredictable. By blaming the timing of these deals, management skillfully shifted the focus from, are people still buying our stuff, to, it's just a timing issue.
And this is where they really pivoted the conversation. Instead of dwelling on the past quarter, CEO Ajay Amlani laid out this clear roadmap for the future. He got investors focused on these 3 pillars: improving the tech, beefing up the sales force, and locking in major partners. It's all forward-looking stuff.
And you know, they didn't just talk the talk. They brought receipts. First up, this massive validation from the Department of Homeland Security. Getting a best-in-class nod from the DHS isn't just a pat on the back. For companies trying to land huge government contracts, this is pure gold. It tells potential customers their tech is legit.
And they didn't stop there. They also got recognized as a Luminary for their ability to fight deepfakes. You know all that crazy synthetic identity fraud we keep hearing about? Well, this report says Aware is one of the top players fighting it. It's another huge credibility boost that reinforces that their tech is top tier.
And just to put a cherry on top, they dropped a hard number. They've made their facial matching speed 14 times faster. I mean, that's not a small tweak, that's a giant leap. It proves they're actually innovating and building a product that can handle serious enterprise-level demand.
So management spun a really compelling tale, and the market bought it at first. But after that initial sugar rush, reality started to set in, creating what we call a show-me market. That post-earnings pop was fun while it lasted, but it wasn't sustainable. In the days that followed, the stock got pretty choppy. The shine of the story started to wear off, and investors started asking the tough questions, weighing the exciting promises against the very real risks that they might not pull it off.
And that brings us to where we are today. The market is basically telling us Aware, okay, great story, love the tech awards. Now, show me the money. Investors are done with promises. They want to see proof. They want to see new deals being signed, and most importantly, they want to see that annual recurring revenue, the holy grail of software metrics, start to climb again.
Now this chart really tells the story of that sentiment shift. You can see that over the last 3 months, Aware's stock has absolutely crushed the broader software index. So even though there's still a lot of skepticism, you can see that the market is starting to believe. The early adopters of this turnaround story have already been rewarded.
All right, let's zoom out for a second. Let's forget the quarterly noise and talk about the big picture. What are the major trends that could really launch this company into its next phase of growth?
Management pointed to 4 huge tailwinds here. You've got the federal government, which is pouring money into border security. You've got massive global events like the World Cup and the Olympics that need top-notch security. Police departments are still modernizing ancient systems. And of course, the huge commercial market where pretty much every company now needs biometrics to fight fraud. These are massive, long-term trends.
And here's the thing that makes you take their big plans seriously. They've got the cash to back it up. With almost $24 million in the bank and no debt, they have a really long execution runway.
That means they can afford to invest in their growth without having to worry about running out of money anytime soon. That's a huge advantage.
Okay, it's time to bring it all home. In this last section, we're going to tell you exactly what to look for, give you our official rating on the stock, and even pitch a potential trade idea for the bold ones out there. So, over the next 6 months, here's your checklist. Number 1, it's all about the numbers. We need to see that ARR start to tick back up, period. Number 2, look for announcements of new customer wins. Did they land a big government deal on the back of that DHS award? And number 3, watch for any new partnership deals that could get their tech in front of more customers.
All right, so after weighing everything, our official rating here at Talk Tickers is market perform. Look, the technology is undeniably impressive, and the story they're telling is very compelling. But the risk is all in the execution. They still have to prove they can turn all this potential into cold, hard cash. Until they do, we think the stock will probably just move with the rest of the market.
And really, it all boils down to this one question. We know the tech works, we know the opportunity is massive, so the entire story now rests on this. Can management actually execute and deliver the growth they've been promising? That's the billion-dollar question.
And finally, for those of you who like to put your money where your mouth is, here's a potential way to play this. The basic idea is to own the stock, but if you want to add some rocket fuel, you could layer in some long-dated call options, maybe for late 2026. This gives the story time to play out, and if they succeed, the upside could be huge. And if you're worried about the whole tech sector, you could hedge by shorting a software ETF. This tries to isolate the bet to just Aware's success.
And of course, we have to say it, this is not financial advice. Everything we've talked about today is for informational and entertainment purposes only. Please do your own homework and talk to a professional before making any investment decisions.